Hey EKFG family, good to see you all. Today I'm presenting to you our third quarter for 2021 update for our Weinberg Portfolio Managed Accounts. So it's nearly Christmas time. We're going to be breaking up tomorrow actually. So I've been meaning to get this out to you the last couple of weeks, but just been trying to close up and get everything tied off for the end of the year. So looking forward to working with you in 2022. I've got a bit of an update of these portfolios now for September quarter. Just rest assured that we'll obviously be looking after you guys over the break, and if you've got any concerns, do reach out. So let's jump into it. So global markets did rise higher over the quarter, aided by ultra-accommodative monetary policy, rising vaccination rates, broad-based easing on restrictions across many economies, and also a stellar US earning season. However, waiting on investor sentiment was renewed inflation fears and a potential for earlier than expected interest rate hikes. So a late quarter sell-off ensued that, which saw September generate the weakest monthly return for global markets since March 2020. So since COVID really hit our shores in March 2020, September quarter has been the worst month for global markets since then. So that just goes to show markets doing really well. Just had a little bit of a sell-off in the last quarter. This culminated into disappointing returns for the more interest rate sensitive sectors such as technology stocks. Technology stocks have been going so great. You're talking about Google and Amazon and all these companies, Tesla, and they've just had a bit of a sell-off in the last month or two because they're pretty sensitive to interest rates. But other sectors that had strong returns and are more positively exposed to inflation, such as energy stocks. The Australian market continued its run of positive performance over the quarter, managing to struggle off the economic impact of continued lockdowns across the country. To the dismay of many economists, the Australian unemployment rate did plummet to a 13-year low of 4.5%. Importantly, that was really based on, obviously due to COVID and a lot of people not being able to work, but then also too, it's harder. We've been finding from a lot of people, it's harder to get people back into the workforce because of all the disaster payments they're receiving. Now that that's cut off, obviously unemployment rate will probably turn around a little bit. But importantly, this reflected a fall in the participation rate, as I mentioned, as an increasing cohort of workers left the workforce. Nonetheless, investors are upbeat as equities remain supported with interest rates anchoring near zero and global economic growth accelerating above trend. So a bit of an update there on the economy and what happened for the quarter. What do we do for the actual portfolio? So look, we took a comprehensive review of the Australian share portfolio, part of our managed accounts, and concluded that we do remain really comfortable with the managers that we have got already, and we elected not to make any changes for the quarter of September. This highlights the long-term approach we take to investing, and that we'll never really make a disruptive portfolio change unless there's an important aspect of our investment thesis that breaks down, or we do find a more compelling investment opportunity that we can look at for you guys. So no change for the quarter, but let's talk about the good performers and best performers. And the core outperformer over the quarter was SGH Ice, which also did perform the best in the prior quarter. They delivered a return of 8.26% for that quarter, just over a 3-month period. So this is due to the manager's highly flexible mandate, which permits investments primarily outside the ASX 100. So they're not looking at the banks and the mines and those big, slower growing companies like Woolies and Coles. They invest more into faster growing, smaller companies. An example of this is the overweight exposure to Australian clinical labs that they have, which enjoyed strong performance due to the increased COVID-19 testings that they had to do during lockdowns. Another familiar name that is in the outperformance for this quarter would be LENOX Australian Small Companies Fund, and they generated 6.19% over the 3-month period. This manager invests solely in smaller Australian stocks, again, typically that grow faster than the mature companies like the some that I mentioned before. And they provide investors with potentially higher returns, but they do come with a little bit of a risk and some volatility, but we manage that for you. One significant contributor to the investment performance for LENOX was Aussie Broadband. So that company in Australia, a small company taking off, they recently partnered with Telstra, which saw their share price rally pretty significantly and pretty hard for that quarter. So a bit of an outlook going forward. So importantly, we do remain optimistic on the long-term outlook of the markets, always do, and particularly in light of the pent-up demand, which will be unleashed once economies fully do reopen up again. So however, the path to share price the share markets do take, to get to that point does remain uncertain. We're not sure about the ups and downs that may or may not be coming. We just want to continue to advocate for quality active management in our portfolio and just navigate around pockets of volatility and just try and get the best outcome for you guys all the time. And if any opportunities or exciting opportunities present themselves, we'll obviously look at those for you. So that's a bit of an update for September quarter for 2021 on your portfolios. You've also got your reports attached to the email we've sent out, so you can have a read. If you've got any questions, just reply to that email. Happily to answer them. Otherwise, looking forward to working with all you guys in 2022. Stay safe for the holidays and wish you a happy Merry Christmas. See you guys. Bye.